let's talk about how to read your balance sheet. The balance sheet is always the place to start because it's how you tell if your other financials are accurate. Your balance sheet tells you information about your company at a moment in time. Because things like your cash balance, your inventory, your loans, any other liabilities or credit cards that you have are constantly changing, you can only run a balance sheet as of a date in time. And for most business owners, the easiest way to do that is by running a balance sheet as of the last day of the previous month. That way it's easy to verify your bank balance and every other balance shown on your balance sheet. The balance sheet is only 3 sections. You have your assets, which are the things that you own. That's at the top, and that takes up the whole top half of the balance sheet. Your assets need to equal any liabilities that you have, plus any equity or retained earnings in the business. So the bottom half of the balance sheet is your liabilities, which are stuff that you owe someone else or another company, plus any equity or your retained earnings left in the business. And that's the best part of the balance sheet. The assets always need to equal the liabilities plus equity. It's the very first thing you should check before even looking at the details of what is in each account. But if you're using accounting software, this is an extremely hard thing to screw up because the balance sheet always has to balance. So once you ensure that your balance sheet balances, let's start at the top. Bank accounts. So pick a period end date, for example, August 31st. At the very top, you should see any checking accounts and savings accounts, and any cash that you might have in the registers or in the store to be used for change. If you're big into profit first and have 8 bank accounts total, you'll see 8 line items here, showing each bank account and the balance in each at August 31st. If you like to keep it simple with just one checking account that you run the entire business out of, you'll see 1 line item here. The cash represented here represents your most liquid assets, meaning that this is the money you have access to quickly should you need to use those funds for an emergency. Once you verify that all of your balances are accurate, you'll know if every transaction has been recorded in your books. If you have a negative bank balance in your balance sheet, but you know that your bank balance in the bank was positive, well, you have too many expenses going through your bank account in your books, more than were actually processed through the bank account. So you need to investigate why, because you can't review any other numbers if you already know that your bank balance is wrong, and therefore you have bad transactions in your books. That's why your bank accounts are always the first place to start when reviewing, because you have to make sure your bank account balances are accurate before you know if the rest of your books are accurate. Once you know that you have accurate cash and bank balances, then it's time to move down the assets. Next up is accounts receivable, and this is the money that you've invoiced clients but have not yet received payment for. Regardless of whether you're cash basis or accrual basis, you can have accounts receivable tracking within your books. But cash basis taxpayers are only required to pay tax on the amount of cash they received. So there's no requirement to keep AR on the balance sheet. If accounts receivable is showing up on the balance sheet, that means that you've already classified the amount that you've invoiced as an income item on your profit and loss. This is consistent with accrual basis accounting, where income is recorded when invoiced or earned, not when the payment is received. If you're accrual basis and pay tax on income when it's earned and invoiced and not when the cash is received from that customer, when you finally receive payment from the customer, your accounts receivable balance on your balance sheet is reduced and your cash is increased. But there's no change to your profit and loss since you already paid tax on that income. Cash basis taxpayers only pay income tax when they receive money. That's why there's no requirement to keep track of accounts receivable balances on the balance sheet. However, the accounting software makes it much easier these days to switch between cash and accrual basis reports when you want to run specific reports, so that it's easy for a cash basis taxpayer to keep an eye on their accounts receivable balances and who owes them money, even if they don't pay tax that way. Inventory. Now the next step down your assets is your inventory, and most businesses probably don't even have an inventory on hand, representing goods that they're going to sell to a customer. But this will be a huge account if you're a retailer or any other small business that resells goods, because This determines whether or not your P&L is accurate. When an item is sold, it's removed from your inventory and put into cost of goods sold on your profit and loss. So if your inventory balance is inaccurate, that means that your cost of goods sold and your profit and loss is inaccurate. Remember, your cost of goods sold is what's driving all of your gross profit percentages and profit margin calculations. We need to make sure that the inventory is accurate compared to your inventory tracking system. And we need to make sure that your inventory tracking system is also accurate. We can adjust the bad numbers from your Square or Shopify POS all day long, but you need to make sure that you're accounting for all of your expenses within that inventory tracking system. Otherwise, that number is useless. This is a huge area where retailers and business owners can't seem to figure out the right way to do it. And often, lose patience very quickly, but that just makes things worse. The inventory systems usually are screwed up. Just plan for that. They don't take into account all the added freight costs and shipping costs and taxes that you pay, in addition to just the regular product cost. So do your best to establish a good process at the beginning to input the amounts correctly and accurately. And double check and verify these numbers consistently so that you know that your financials are accurate. Next up should be anything a little bit less liquid, but funds that can still be reached should they need to be. Usually you can expect to see things like investments that are made in something like a brokerage account with TD Ameritrade or Schwab. Money that's in the market or invested, but money that you can access if you need to sell it to use it for business cash. You can also invest in things like Bitcoin and another cryptocurrency. More and more business owners are starting to store money here in the hopes that it will earn a higher rate of return than their savings account. Fixed assets. After ensuring that those investment account balances are accurate, you can move down the asset section of the balance sheet. And the next section should be fixed assets. This represents any large equipment purchases that you've made for the business for items that will be utilized over a period of years to generate business income or to conduct business operations. When you purchase something like a camera, a printer, a forklift, a commercial freezer, any other large piece of equipment that in theory will be utilized over a period of a couple of years to generate income for the business, it needs to be listed on your balance sheet as a fixed asset. And this is what we call capitalizing the expense. Since you'll be using it over a period of years, you shouldn't benefit from the full expense in the year that you purchased it. So the rules require us to depreciate that asset over the life of the asset. Luckily, there's something that benefits business owners in the IRS code called Section 179 depreciation. And this allows for the acceleration of depreciation expense for those large asset purchases. So even though, for financial statement purposes, the expense shouldn't be recognized all at once, you can still get the full deduction when we file your tax return. And those are the most common asset classifications that we see in almost every business. Cash, AR, inventory, some other form of investment where that money is not as liquid as cash but can still be reached, and then fixed assets, which are much more difficult to turn liquid. And there are just two other asset categories. Other assets, this is everything else. This is a catch-all for money that you've loaned to people, your security deposit on your rental space, since you technically gave that money as a loan to your landlord. And if you invested in other entities through the business and not personally, those would be shown here. Lastly, any intangible assets that the business has. Intangible assets are things that can't be valued or defined, like goodwill, patents, non-compete agreements. If you carry these on your balance sheet, that likely means that they were purchased from another entity. If you come up with a really cool software product and file a patent for it, that doesn't show up anywhere because there's no value in that. However, if you purchased a software company and included in that purchase is their patent and other goodwill, those assets would show up as intangible assets because a value was placed on them when they were purchased. And those must be depreciated over 15 years or the life of the intangible asset. So the key when running down your balance sheet is just to make sure that you understand the value of what your business owns and make sure that it's accurate. Make sure no other odd purchases are running through your fixed assets and equipment. And make sure that there's no negative balances on your asset accounts. Now let's talk about how your assets move. So every time you spend money out of the company bank account, your bank balance decreases. And either the transaction shows up on your profit and loss as an expense, or as an asset if you purchase something like inventory or loan someone money. Or it can reduce a liability if you're paying down principal on debt. Those are all balance sheet transactions. And money out of your bank account can also be an equity transaction if you're reducing your equity in the business by pulling money out of the bank account and paying yourself. It's important to remember that those balance sheet transactions do not affect your net income at all. Money into your bank increases your business's bank balance and sales, affecting the overall net income. Or it might not affect your income at all. If you received a loan from the bank, the money into your bank account isn't taxable income to you. It's a liability. So your liability is increased, as does your cash. If you're putting money into the business as a business owner, contributions are an equity transaction that doesn't affect your profit and loss at all. It just increases the amount of equity you have in the business. Inventory increases when it's purchased and decreases when it's sold. The purchase can either be by reducing cash in the bank account or taking on more debt by paying for the inventory with credit cards and loans. When items are removed from inventory and put on the profit and loss as a cost of goods sold item, that's a manual process because your bookkeeping software won't be smart enough to know when you sold something, since it just sees the bank transactions and doesn't know specific details behind the deposits. So make sure you're keeping an eye on your inventory number because adjustments will need to be made. Fixed assets increase either as the bank account balance decreases or as loans are increased if you finance the asset purchase. Fixed assets decrease whenever depreciation is taken. So as the expense is recognized on the profit and loss, the asset's value also decreases, which is reflected on the balance sheet as an accumulated depreciation of the asset. Other assets increase as money out of your bank account goes to someone who you're loaning money to, or if you're investing in another entity. And other assets decrease as the money comes back to you. Intangibles increase when they're purchased as a part of the sale of another entity. And they decrease similar to fixed assets when the amortization expense is recognized on the P&L. Once you're comfortable with your assets, it's time to move down to liabilities, the stuff that you owe others. Usually, first up is accounts payable. Similar to accounts receivable in the asset section, where the AR represents money that is owed to you, accounts payable represents amounts you owe others. If you're a cash basis taxpayer, you don't need to have an accounts payable balance on your balance sheet. However, if you're an accrual basis taxpayer, you need to enter every single invoice that you receive as a bill to report at any given time what the business still needs to pay its vendors. If you run your balance sheet and realize that your AP balance is triple what you expected it to be, maybe that means that instead of posting payments that were made against the bill, someone posted them as separate expenses. So basically, double posting your transactions. You should have already caught that because your bank balance would have been very incorrect, but that's okay. If you missed it, now is the perfect time to correct it. So that's one area that mistakes happen frequently. Credit cards. After AP is usually credit cards and other short-term debt that you have to pay off in less than 1 year. So these are items that you know the business will have to come up with the money for within the next year. Keep an eye on your credit card debt because this can get out of hand quickly, and those interest rates are unforgiving. Try to get this paid off in full every single month. Earn that cash back or those rewards that the credit card gives you. Don't waste them by paying $500 a month in interest payments right back to that company. Current liabilities. Other items that might show up in current liabilities are payroll payable, payroll taxes payable, and sales tax payable. These are amounts owed to employees or taxes collected from employees or from customers that you need to remit to a government agency. Long-term liabilities are next, and these are the principal amounts that you owe back on loans. If you have a 30-year SBA loan or a TD Bank line of credit, the current principal balance will be listed here. Remember that these liability totals only represent the principal portion. Interest amounts owed don't reduce your loan. They're expenses that show up on your profit and loss statement. So $1,500 might come out of your bank account, but only $1,000 will reduce your principal balance on your loan, and $500 will be an expense on your profit and loss that reduces your taxable income. So let's talk about how liabilities move. An increase in your accounts payable means that you recognize the expense on your profit and loss but haven't yet paid the bill. So this is a step accrual basis taxpayers have to worry about. And the AP balance decreases once the bill is paid and cash is also decreased. The credit card liability increases when an item is expensed and the expense shows up as either a fixed asset on the balance sheet or as an expense on the profit and loss. The liability decreases when cash is paid out of the business bank account to reduce the balance of the loan or credit card. The same is true for sales tax payable. That is money that you collected from the customer for the government. So every time you deposit money into your bank account that includes sales and sales tax, $100 will be recorded as sales in your profit and loss, and $6 will be put to your sales tax liability account on your balance sheet, increasing your liability. And that account will keep rising until you pay what is owed one day. So next month, when you pay the sales tax to the government agency, the $6 that went out of your bank account also reduces the $6 sales tax liability because you don't owe that to anyone anymore. Remember, taking on debt isn't a taxable event. You don't pay tax on money borrowed. So if you get $50,000 deposited into your business bank account from TD Bank for a line of credit you opened up, that increases your cash by $50,000 and increases your liabilities by $50,000. When the loan is paid back, a portion of the payment affects your balance sheet to reduce the principal, and a portion is for interest that goes on your profit and loss, reducing your taxable income. So I think that's it for liabilities. Next up is equity. The equity section is everything else that's left over. If it isn't an asset and it isn't a liability, it must affect equity. Remember, equity is equal to your assets minus your liabilities. So if you have $100,000 of business assets and business credit card debt of $25,000, you already know that your equity in the business is $75,000. Your equity section can differ based on business ownership, entity structure, and agreements among partners. But the overall concepts are the same. The main difference being the references to the owners, whether they're called officers or owners or partners or shareholders. Contributions. Money put into the entity, either as startup capital or to help float the business bank account, is considered an owner contribution. It does not have any profit and loss effect at all, but it increases the owner's contributions into the business while increasing the bank account balance. Distributions. And this is the opposite of contributions. Distributions represent money that you've taken out of the business that wasn't via W-2 payroll or guaranteed payments. This is also where you'll see personal expenses if you've paid for them with the business credit card. So all of your Xbox subscriptions and games, this is where you'll classify those payments. They aren't business expenses, so they don't belong on your P&L. It's effectively the same as you transferring money to your personal bank account from the business and then spending that money on Xbox stuff from your personal bank account. Be very careful not to distribute so much money to yourself that you end up with negative equity in the business. Net income. Net income represents your current sales for whatever period you ran the balance sheet for, less any applicable business expenses. If you run a profit and loss for the exact same period as your balance sheet, this is the net number at the bottom of your profit and loss statement. Retained earnings. Your retained earnings are the accumulation of all past profits, plus the money you've contributed, less money you've taken out of the business. Starting January 1st of every year, the prior year's net income is automatically swept into retained earnings. And we recommend zeroing out the contribution and distribution accounts to retained earnings as well to start off the new year fresh and not carry all of those balances for the life of the entity. Essentially, your equity in the business represents your cost basis should you sell the business one day. Your cost basis can be used to reduce the sales price of the business so that you only pay tax on your gain. If you have equity of $500,000 in the business and sell it for $1 million, you only pay cap gains on $500,000. Very similar to a stock. But if you pull all the money out of the business as you earn it and operate the business with about $1,000 of equity, you can expect to pay tax on $1 million tax gain, on $1 million gain for that sale. It's healthy to have a nice fat equity balance in your business, which usually means you have a lot of cash to play with, which is a great advantage. So let's talk about how equity moves. Contributions increase when money is put into the business from an owner of the business. The only time contributions should decrease is if a journal entry is made to zero out the equity accounts to retain earnings at the start of a new year. Distributions increase when money is paid out of the business bank account or credit card for personal expenses of the owner, or when distributing money to the owner. If the owner is paying themselves for their hard-earned work, this is where the payments go. The only time distributions should decrease is if a journal entry is made to zero out the equity accounts to retain earnings at the start of a new year. Net income increases as profit is earned and sales are higher than expenses. Net income decreases when expenses exceed sales. Retained earnings move based on the other three components of equity, including the consistency of income and the owner's traits. If a strong business consistently turns a profit and distributes very little cash to the owner, the retained earnings will continue to grow year after year, which is the sign of a strong company. If cash is taken personally by the owners immediately after it's earned, the retained earnings will always be very low to zero or even negative. And that's not a great sign. But it is common to see a few years of consistent growth in retained earnings, followed by a downward trend for some years, and then more upward movement. That's to be expected for a business. That's why it's important to leave cash in the bank account to plan for when things aren't going so well. That's the balance sheet in a nutshell. Everything that you can expect to see when you run a balance sheet report, and a little bit more about how the balances that you're looking at are moving. Behind these numbers are just transactions. Money in, money out. It's all coming from somewhere. So if you don't feel confident, focus on one or two numbers or accounts and dig deep into them until you understand what's making them up. You can also compare this balance sheet to this date last year. See what's better. See what's worse. Use this to set some goals for yourself. What do you want your total assets to be by this time next year? How about by year end? It will take time to get used to the balance sheet, but it will be incredibly helpful for your financial analysis into your business once you do. Now that you know all about how to read your balance sheet, whenever you're all done with it, meet me at the profit and loss. And make sure you check out the video where I run through a few balance sheets and explain a little bit more about what's on them and what I see when looking at them.